If you watch a lot of finance-related channels on YouTube, it's almost certain that you've been targeted with ads for various penny stock get-rich-quick schemes. They almost all have the same format. Some talking heads will tell you that the economy and stock market are about to collapse, and that 90% of people will have their life savings wiped out. But they have found a secret method to take advantage of the coming chaos and make a life-changing amount of money. So you will pay a few $1,000s for their research report, which will tell you to buy some penny stocks or cryptocurrencies. The returns are almost always disastrous. While most people can see that these penny stock research reports are little more than snake oil, there are a few people who get sucked into paying for them. And because the prices are so high, the operators of these newsletters can make hundreds of millions of dollars. This part of the financial industry has historically operated in the shadows with very little accountability. But in the past couple years, the mask has finally been lifted. One of the biggest players in the industry over the past 2 decades has been a man named Frank Porter Stansberry, the founder of Stansberry Holdings, which eventually changed its name to MarketWise. Mr. Stansberry portrays himself as a financial genius, and his pricey stock picks level the playing field for individual investors. In 2021, he took his company public by merging it with a SPAC at a valuation of $3 billion. While he stepped down from the company shortly before the merger, the disastrous share price performance cements his legacy. Through MarketWise's public filings and other publicly available information, we can finally unmask the predatory and deceptive nature of the penny stock newsletter industry. In the late 1990s, a young man by the name of Frank Porter Stansberry realized that he was interested in investing and wanted a career out of picking stocks. There were 2 options. He could start an investment fund and manage other people's money. The problem is, the money management industry is highly regulated, and there was onerous disclosure requirements meant to protect investors. The other option was to start a financial newsletter. You can publish a paid newsletter that recommends to readers what stocks they should buy. Because you're not actually managing client money, the regulatory burden is far less. Pretty much anyone can start writing a newsletter if they can find paying customers. In or around the 1990s, Mr. Stansberry started working for a newsletter company called Agra Inc. Agra published dozens of different paid newsletters focused on investing, health, and other areas. Because the barriers to entry are so low, the paid newsletter industry is very competitive. If you want people to buy your newsletter, you need them to believe your information is valuable enough to justify the price. Agra decided to specifically target older Americans with conservative political leanings. They would pay influential Republican politicians such as former Arkansas Governor Mike Huckabee and former House Speaker Newt Gingrich for access to email lists to their supporters. They used these lists to send out mass email campaigns advertising their newsletters. According to an investigation by Mother Jones, these newsletters were often of low quality, if not outright scams. For $74, you could access a report which would show you a cure for cancer, hidden in the book of Matthew. While these paid newsletters might seem ridiculous, there were some people who believed the absurd claims, and Agra grew to hundreds of millions of dollars in annual revenue. While working for Agra, Mr. Stansberry started writing financial newsletters, which were very successful. Stansberry quickly gained the recognition of Agra's CEO Bill Bonner, and they founded Stansberry Research, a company focused exclusively on financial newsletters. Stansberry Research was eventually spun out as an independent company, but for the first few years it was part of Agra. It appears that Mr. Stansberry implemented a lot of the same marketing methods that Agra developed over the years. The main strategy was to send out advertisements making huge promises to potential customers to entice them to pay high fees to access the newsletter. In 2002, Stansberry wrote a newsletter called The Pirate Investor. On or around May 14, 2002, Stansberry sent out mass emails to 800,000 people on Agra's mailing list, titled, "Double your money on May 22nd on this super insider tip." May 22nd was less than 2 weeks away, so the sense of urgency was high. In the email, Stansberry elaborated that he had received insider information from a senior executive at a small-cap company. The company was involved in the nuclear energy field and stood to profit to the tune of $2.5 billion due to an arms reduction treaty between the US and Russia. When the deal was announced, Stansberry said the stock would double. He was so confident in this trade that he recommended putting your entire portfolio into this one stock. Of course, there was a catch. To learn what this stock is, you would have to pay $1,000 for the research report. But given the fact that the stock was going to double, this was a small price to pay. Indeed, over 1,000 people paid for the report, netting Agra over $1 million. The stock in question was USEC, a company that supplies nuclear fuel to civilian nuclear power plants. According to Stansberry's report, USEC reached an agreement with the Russian government. They would buy dismantled nuclear warheads at a reduced price, following the implementation of an arms reduction treaty. The deal needed approval from both the US and Russian governments. US President George W. Bush and Russian President Vladimir Putin were scheduled to attend a summit meeting on May 22nd. According to the USEC insider, USEC would announce the approval of the deal right before the summit meeting. On May 22nd, USEC failed to announce any deal. The stock price fell by 15% as Stansberry's victims realized they'd been conned and dumped their shares. The insider in question was a man named Stephen Wingfield, USEC's Director of Investor Relations. Stansberry did not receive an insider tip from Wingfield. Under Regulation FD, investor relations representatives of public companies are required to tell the same information to all investors, and that's exactly what Wingfield did. He told Stansberry what he told all investors, that USEC expected the contract would be approved in the near future. He said nothing about May 22nd. Basically, Stansberry was lying. There was no insider tip. Shortly thereafter, the SEC opened an investigation into potential violations of securities laws. Even after AGRA became aware of the investigation, they continued to make outrageous and fraudulent claims in their marketing materials. Their advertisements included, quote, "Turn $10,000 into $144,280 by April 18, 2003, unquote. And, quote, "Almost unbelievable profits, 4.5 times your money in 48 hours, unquote. These reports pitched various penny stocks, almost all of which ended up being complete failures. Eventually, Mr. Stansberry and his company Pirate Investor LLC, which at the time was a subsidiary of AGRA, were forced to pay $1.5 million in restitution to his victims, as well as civil penalties. This legal setback didn't deter Mr. Stansberry. He continued his financial newsletter business and eventually spun it out from AGRA to become an independent company called Stansberry & Associates Investment Research. He continued using deceptive and sometimes outright fraudulent marketing tactics. In 2011, Stansberry had to pay a $55,000 settlement to the Social Security Administration for promoting a misleading publication claiming that they found a way for people to get Social Security payments no matter your age. That same year, he published a bizarre hour-long infomercial called The End of America. The video consists of a slideshow with words and charts, with Mr. Stansberry narrating in the background. He starts off by establishing credibility by claiming to have predicted the 2008 financial crisis all the way back in 2006. He says that he warned investors to avoid Fannie Mae, Freddie Mac, Bear Stearns, Lehman Brothers, General Motors, and dozens of other companies that have since collapsed. Not only that, but he recommended that his readers short these companies and buy put options to benefit from the collapse. In fact, no other research firm in the world can match Stansberry's record of correctly predicting the 2008 financial crisis. Frank Porter Stansberry is a great genius who is able to predict the market crash years in advance and profit from it. Now, in 2011, Mr. Stansberry sees an even bigger crisis on the horizon. He'll tell you what this crisis is and how to profit from it, of course for a price. Mr. Stansberry created a huge paid marketing campaign for his End of America infomercial, causing it to receive millions of views. This caught the attention of Peter Schiff, the founder of a broker-dealer called Euro-Pacific Capital. We've talked about him on this channel before. He is verifiably one of the few people who predicted the 2008 financial crisis as early as 2006. We can verify this because he gave an interview on CNBC in 2006, saying that a recession would start in either 2007 or 2008 due to excessive debt accumulation across the economy. Although he's predicted 15 out of the past 2 recessions, so take that as you will. Regardless, Schiff does deserve credit for his accurate prediction. When he saw Stansberry's claims of also having predicted the recession, he did some investigations to see if it was true. Mr. Stansberry never gave any public interviews predicting the recession, so Schiff contacted Stansberry Research asking for any proof that Mr. Stansberry predicted the recession. A staffer at Stansberry Research gave Schiff access to all of Stansberry's paid newsletters from 2006 through 2008. In 2006 and 2007, not a single one of Stansberry's newsletters gave any warning about a financial crisis or market crash. He did not recommend shorting a single financial stock, not Bear Stearns, not Lehman Brothers, nothing. In 2007, he didn't recommend a single short position. In fact, in October of 2007, he recommended buying shares of an insurance company called Markel Group, which then proceeded to lose half its value during the market crash of 2008 and 2009. He didn't put on a single short position until April of 2008, while he had 22 long recommendations. This was months into the financial crisis, and Bear Stearns had already gone bankrupt by this point. He never told his readers to buy any put options. In June of 2008, he did in fact recommend shorting Fannie Mae and Freddie Mac, which was a good call. But this was well into the financial crisis, and their stocks had already declined by more than 50% at that point. So this does not support the claim that he saw the crisis coming before anyone else. At this point, he was recommending 23 long positions and just 3 short positions. Not only did Stansberry fail to predict the financial crisis, when it did happen, he thought it would end far sooner than it actually did. In August of 2008, he recommended buying shares of the municipal bond insurance company MBIA. The stock proceeded to lose another 2/3 of its value over the next year and a half. There is zero evidence that Mr. Stansberry predicted the financial crisis in 2006 or 2007. And of course, the infinitely more dangerous crisis he predicted in 2011 never materialized. Near the end of his infomercial, he gave a few recommendations as well as a sales pitch to buy his research products. One of his recommendations was to buy silver. He said that silver could rise to $187 per ounce. In 2011, the silver price was more than $30 per ounce. Today is about $23. It never came close to his $187 price target. While the silver prediction turned out disastrously, there's nothing illegal or inherently immoral about giving investment advice which turns out badly. It is likely that Mr. Stansberry truly believed that silver was a good investment. But his next recommendation is where things really get shady. He said that he had found a secret strategy to safely extract gains of exactly 100% from the market over and over again, and you don't even need to buy any stocks. Some of Stansberry's clients have employed this safe and secret strategy to make an average of $10,000 per month. To find out what this super secret strategy is, you have to buy his research report. I didn't buy his research report, but it's quite obvious what he's talking about. What he's recommending is to sell cash secured puts. You sell a put and collect the premium up front. If the stock falls below the strike price, you are required to buy the stock for the strike price, thus recognizing a loss. First of all, there's nothing secret about selling puts. Any degenerate on Wall Street bets knows how to do this without paying Stansberry for a research report. And his claim that this strategy is safe is extremely misleading. The only way you can make a 100% return is if you sell a put that is significantly in the money, and the stock price would have to increase substantially for your put not to be called. Thus, it is economically very similar to just buying the stock. But his entire sales pitch was that this is a much safer method than buying stocks, which he recommends avoiding because of the great financial crisis that he's predicting. He gives a large number of supposed testimonials of customers who have made life-changing amounts of money by following his advice. These testimonials are almost impossible to independently verify. In the testimonials, Stansberry gives the names of the individuals and where they are from. This is meant to give the impression that they are real people, although don't waste your time trying to find any of them. An investigation by the nonprofit consumer advocacy group Truth in Advertising conducted an investigation and found a number of anomalies. For example, in 2 separate testimonials, 2 separate supposed customers claimed to have earned exactly $72,389 by following Stansberry's stock picks. In another case, 2 separate supposed customers claimed to have earned exactly $15,460. Eventually, Stansberry officials admitted that they changed the names of the customers in the testimonials to protect their identities. This was not previously disclosed. Given Stansberry's proven history as a con man, his baseless claims about predicting the financial crisis, and the anomalies in the testimonials, one could wonder if the supposed customers ever existed. 1 year later, in or around 2012, Stansberry conducted a separate marketing campaign on various right-wing news sites. He promoted a bizarre conspiracy theory that then-President Barack Obama would seek to run for a 3rd term in 2016. This would create a major shock for the US economy, and Stansberry will tell you how to profit from this for a price. Throughout the 2010s, Stansberry Holdings acquired and built a number of paid newsletter brands in addition to their flagship Stansberry Research service. In or around 2021, they changed the company's name to MarketWise ahead of their SPAC merger. So why does Stansberry have so many brands? Why not aggregate all of their financial research under one brand? To understand MarketWise's strategy, we have to understand how they make money. They have cheaper plans which cost a few $100s per year. According to their SPAC presentation, they had 658,000 so-called paid subscribers. These are people who only buy the lower priced offerings. These newsletters will recommend boring large cap stocks. Each of these paid customers have a lifetime value of less than $600. This represents an aggregate lifetime value of less than $400 million. Then they have high value subscribers who pay thousands of dollars for premium research. These newsletters provide recommendations for more speculative assets like penny stocks, options, and cryptocurrencies. Each high-value customer has a lifetime value of about $2,500. They had 233,000 high-value customers, which represents an aggregate lifetime value of about $600 million. And then they have ultra-high-value customers who pay many thousands and sometimes tens of thousands of dollars for bundles of multiple newsletters. They had 110,000 ultra-high-value customers, which represents an aggregate lifetime value well in excess of $550 million. This is a minimum number. Thus, the majority, if not the vast majority of their revenue comes from the high and ultra-high value customers. The way it works is a customer will begin subscribing to a low-price newsletter. They'll get recommended some large-cap stocks. These stocks may or may not perform well over a long period of time, but they're not going to make you rich overnight. Once you sign up for the cheap subscription, they'll bombard you with advertisements for their premium newsletters, which promise the potential for life-changing returns with penny stocks or cryptocurrencies. These newsletters cost thousands of dollars. The problem is, most of these newsletters are not very good at picking penny stocks, and the returns from their recommendations are almost always disastrous. All of the MarketWise brands have horrible reviews on third-party review sites like Trustpilot, with the majority of the reviews being 1 star. If you pay thousands of dollars for some penny stock recommendations and they turn out disastrously, chances are you're never going to buy any research from that company ever again. It's common in casinos that after losing a bet, instead of giving up, the gambler will double down, betting again in an attempt to make back their losses. There may be a similar psychological phenomenon at play with penny stock newsletters. As a hypothetical example, you might have lost hugely on recommendations from Brownstone Research. You now no longer trust them, so you won't pay them again. But then you get an ad from Palm Beach Research promising life-changing returns, so you try them, hoping to make back the losses from Brownstone. You may not know that both Brownstone and Palm Beach are owned by the same parent company, MarketWise, formerly known as Stansberry Holdings. In Trustpilot reviews, many customers complain that their email address is being sold to other companies, as their inbox is inundated with get-rich-quick schemes under a wide range of brand names. In reality, MarketWise does not sell their customers' email addresses, but they do cross-promote across their various brands. It is not obvious to many customers that they are all owned by the same company. Stansberry copies and pastes its previous marketing gimmicks to the new newsletter brands that they create or acquire. For example, in 2020, they launched a new brand called Brownstone Research, which was ostensibly run by a man named Jeff Brown. He started an infomercial eerily similar to Stansberry's End of America infomercial from 2011. Jeff Brown claims to have predicted the fall of the Soviet Union, the dot-com bubble's collapse, President Donald Trump's surprise victory, and the meteoric rise of Bitcoin. I could find no evidence for any of these predictions. He then warns of an impending financial catastrophe that will devastate ordinary investors and retirees. But he found a way to make extraordinary profits from this looming disaster. All you have to do is pay a few $1,000s to access his research report. The man interviewing him appears to be a news anchor, but in reality, he is an actor hired specifically to make this infomercial. In July of 2021, MarketWise took advantage of the SPAC mania to go public by merging with a SPAC at a $3 billion valuation. Mr. Stansberry stepped down as CEO shortly before the merger, but he touted the merger as a vindication of his life's work. In May of 2022, he gave an interview where he talked about how he built MarketWise over the past 2 decades. He credited his unparalleled investing acumen as well as a few high-profile hires as the keys to the company's success.
And so for a guy with, like, for example, with Empire Financial, I wanted Whitney Tilson. Whitney Tilson had started writing about stocks in the 1990s. He had a very successful hedge fund. He's been on 60 Minutes 3 times. Like, he is credibility. And when he got out of his hedge fund business, the 2 places he was likely to go work were either Stansberry or Motley Fool. And so I'd been recruiting him since 2003, 2004. And I'd sent him lots of, good information on stocks. It helped him with his hedge fund. So he knew me and he was willing to come over, and we started in 2017. And that business now, Empire, is probably worth $100 million now.
Whitney Tilson ran a hedge fund called Case Capital Management, which managed $180 million at its peak. According to Mr. Stansberry, Whitney Tilson was a great financial genius, and it was a big win when he finally convinced him to join MarketWise as an editor. What Mr. Stansberry failed to mention was that Whitney Tilson shut down his hedge fund in 2017, after suffering sustained poor results and massive redemptions. The fund's assets had declined by more than 2/3 to $50 million. In a letter to investors, he said he could not in good conscience continue to manage their money, as he was not confident he could turn things around in a reasonable time frame. While Mr. Tilson wasn't good enough to run a hedge fund, he apparently was good enough to run a new MarketWise subsidiary called Empire Financial Research. Like all of MarketWise's brands, it has atrocious reviews on Trustpilot and the Better Business Bureau. In the same interview, he makes another pathetic attempt to burnish his image by claiming hedge fund managers read his newsletters.
I think that piece right there is something that people don't realize in the publishing space, which is that if you have the quality of product that you're talking about, it's not just the mom and pop retail investor who's buying them.
Oh no, not at all. Yeah. Every hedge fund in the world reads my work.
The claim that there's not a hedge fund in the world who doesn't read Stansberry's newsletters is absurd on its face. Not only that, but it's provably untrue. There's a hedge fund called Focus Capital Management. They publish so-called postmortems on their website, where they talk about successful and unsuccessful trades they've made in the past. They bought shares of MarketWise shortly after the merger in July of 2021. They sold it in November of 2022 for a 75% loss, making it their worst investment ever at the time. Focus Capital described the quality of MarketWise's investment advice as poor to fair, and they are very aggressive in their advertising. They would advise everyone to stay far away from it. It is similar to Motley Fool, but with worse investing advice and sleazier advertising. So that's at least one hedge fund that doesn't read Mr. Stansberry's newsletters. Focus Capital knew that the product was of poor quality, but they invested in the company anyway because they thought the aggressive marketing tactics would continue to drive revenue growth. Throughout the 2010s, MarketWise's revenue grew strongly as they acquired and launched new brands. With their aggressive cross-promotion strategy, they were able to extract huge amounts of money from their subscribers. But this strategy has its limits. Eventually, customers catch on and realize they're getting ripped off. In 2022, revenue growth turned negative, and the business has been steadily deteriorating ever since. Since the SPAC closed, the share price has declined by more than 80%, putting the company only slightly above penny stock territory. Mr. Stansberry was furious with the disastrous share price performance of the company. In January of 2023, he sent an angry letter to MarketWise's board of directors. He said Mark Arnold, the SPAC sponsor, promised me that I would receive roughly $100 million in cash at the IPO of the company in exchange for between 12 and 15% of the shares. In what I can only describe as the most ruinous business transaction in history, if not plainly fraudulent, MarketWise chose to move forward with our IPO even though virtually all of the money Ascendant promised us was redeemed by their investors. Ascendant was the name of the SPAC. Who in their right minds would have agreed to this deal? He's complaining that the vast majority of the SPAC shareholders voted to redeem their shares, leaving MarketWise with far less money than he expected. This is how SPACs work. Investors are free to redeem their shares before the transaction closes. Even if there are significant redemptions, the sponsor still receives millions of dollars worth of shares for free. It does seem like a pretty bad deal. What kind of idiot would possibly agree to this? None other than Frank Porter Stansberry. He personally signed off on the SPAC transaction that he's now criticizing. Mr. Stansberry likes to portray himself as a great genius who understands financial markets better than anyone else. Yet it appears that he didn't even know how SPACs work, even as he merged his own company with one. Perhaps Mr. Stansberry thought that taking his company public would cement his legacy as a legendary investor. Instead, he will be remembered for what he is, a con man and a clown. Alright guys, that wraps it up for this video. What do you think about Mr. Stansberry? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.